There's a video going around promising that a $100,000 dividend portfolio turns into $2.76 million dollars and pays you $10,000 a month. I'm not going to tell you that's a lie. I'm going to show you the math nobody walks you through. What's actually left after taxes, after inflation, and after 30 years of assumptions stacking on top of each other. By the end of this, you'll know exactly what $100,000 in dividends really pays you today and decades from now, and you'll be able to build one yourself by this weekend. A dividend is simple. You own a slice of a company. The company shares its profits with you in cash on a schedule, whether the stock had a good day or a bad one. Think of it like owning a rental property where you never have to fix a toilet. The rent still shows up whether you're watching or not. Reinvest that rent instead of spending it. Most brokerages do this automatically now, even down to fractional shares, and something interesting happens over time. Those reinvested payments start throwing off their own payments. But here's the part almost nobody says out loud. A dividend isn't free money. When a company pays one, its stock price usually drops by close to that same amount that day. You're not getting a bonus. You're getting your own money handed to you on a schedule. The real wealth comes from the company growing and raising that payment year after year, not from the check itself. Now here's where it gets interesting though, because not every dividend stock deserves your money, and the ones that look the most tempting are usually the ones to be most careful with. Before buying anything, run it through a quick checklist. Has it paid, ideally raised, its dividend through an actual recession, not just a good few years? Is the payout ratio under about 60%, so there's room to keep paying if a bad year hits? REITs are the one exception here, and this trips people up constantly. They're required by law to pay out most of their income, so their payout ratio can look like 150, 200, even 260%. That's normal for a REIT, not a red flag. You just check a different number for them, funds from operations, not net income. Past that, be suspicious of any yield screaming for attention in the double digits out of nowhere. That's usually the market pricing in a future cut, not a bargain. Two last checks. Don't cluster too many holdings in one sector and mix in a payout schedule or two. Most dividend stocks pay quarterly, so a little monthly income keeps the calendar smooth. So let's actually put $100,000 to work using that checklist and clear up the one part of this that trips almost everyone up. But before that, if you like more content like this, make sure to hit that subscribe button so you don't miss out on future videos like this. And I hope you enjoy the rest of this video. So first, we're going to split it into 4 buckets. 10% into one broad dividend ETF as the anchor, something like SCHD, which screens hard for financial strength and consistent payers. 50% spread evenly across 5 blue-chip dividend stocks, the boring, decades-old consumer staples and healthcare names people use in any kind of economy. 10% into one real estate investment trust that happens to pay monthly, filling in the gaps between everyone else's quarterly checks. And the last 30% split across 3 dividend growth stocks, lower yield today, but built to raise that payment faster over time. That's 10 positions, 10% each, adding up to 100%, not 10% per bucket, which is where a lot of these breakdowns get muddy. Now, here's something worth saying plainly. Any exact yield quoted in a video like this is already a little out of date by the time you watch it, since yields move every time a stock price moves. Right now, the data I used is as follows. That ETF anchor is yielding somewhere around 3%, that monthly REIT is around 5%, and most of the blue chips sit somewhere between 2 and 4%. The exact number moves constantly. The checklist you just heard doesn't. Now plug those numbers in, and here's what actually shows up in the account, and it's smaller than you'd think, on purpose. And mind you, this is year 1. Blend those weights against today's real yields, and $100,000 built this way generates somewhere around $3,000 a year, roughly $250 to $275 a month, month 1. It's less like a phone bill and more like a tip jar that never quite runs empty. Fuller some months, thinner others, but never at zero. Let's be honest, $250 a month on $100,000 is not retirement. It's a phone bill or part of a grocery run. Anyone telling you this replaces a paycheck starting year one is selling you something else. Remember that $2.76 million number from the very beginning of this video? Here's exactly where it comes from. Getting from $100,000 to $2.76 million over 30 years with every dividend reinvested the whole time requires an average total return, yield, share growth, and rising payments combined of somewhere around 11 to 12% a year, compounded. For context, the stock market as a whole has historically averaged closer to 9 or 10%, including dividends. So this number isn't fantasy, but it's one of three possible outcomes, not a guarantee. Call them conservative, moderate, and optimistic. Conservative, around 7% a year, lands near $760,000 after 30 years. Moderate, around 9%, lands near $1.3 million. Optimistic, at 11 to 12%, is that headline $2.76 million figure. All three only work if the money is never touched for 30 straight years. The moment dividends get spent instead of reinvested, the curve changes completely. Decide early which phase you're actually in: building, where everything gets reinvested, or living off it, where you're spending. Trying to do a little of both is how people end up disappointed by year 20. And before you assume any of those three lanes are guaranteed, remember no dividend is bulletproof, including the household names. AT&T cut its dividend nearly in half in 2022 after spinning off part of its media business, after years of being considered a safe income. Intel, a company that had paid a dividend for decades, cut it in 2023, then suspended it completely in 2024 while restructuring through heavy losses. If you'd built a safe tech dividend portfolio a few years ago, Intel would have looked like one of the sturdiest names on the list. The lesson isn't to avoid dividend stocks, it's that no single name is bulletproof, which is exactly why spreading across sectors matters more than chasing any one high-yield pick. Now, here's the part almost nobody puts in these videos, and it changes even the best of those three lanes. Where you hold this account matters as much as what's inside it. Inside a Roth IRA, that income can eventually come out completely tax-free. Inside a traditional IRA or 401k, you don't owe anything year to year, but you'll pay ordinary tax when you withdraw later. In a regular brokerage account, you owe tax the year the dividend hits, even if you reinvest every cent. Reinvesting doesn't make it invisible to the IRS. And here's the detail that trips up even experienced investors. Most blue-chip dividends qualify for the lower long-term capital gains rate, but REIT dividends usually don't. That monthly check is convenient, but it's typically taxed like ordinary income at your regular bracket. Exactly why a lot of investors tuck their REITs inside a retirement account if they can. Then there's the other number nobody adjusts for: inflation. Prices have historically climbed a little over 3% a year on average, which means $10,000 30 years from now doesn't buy what $10,000 buys today. It's closer, in real terms, to $4,000. Still meaningful, just not the number it sounds like on the screen. A few habits quietly wreck this strategy fast. Chasing the highest yield on the screen instead of asking why it's that high. Assuming every stock pays monthly when most pay quarterly. Dumping too much into one hot sector, and cashing out dividends as income while you're still supposed to be building. So here's the honest version. Built right, $100,000 in dividends might hand you around $250 to $275 a month today. Reinvested for decades, it could realistically land in the conservative, moderate, or optimistic lane, somewhere between $700,000 and $2.7 million, depending on which one the next 30 years actually turns out to be. And what you keep after taxes and inflation is the number that matters, not the one on the thumbnail. If you had to pick one of those three lanes right now to actually plan your life around, tell me which one in the comments. I read every single one. And if you want to know what happens when you put $10,000 into the best Fidelity funds, make sure to watch this video as well.